You're listening to the Valley Current.
I want you to do something for me, like right now as you're listening to this. Just pull out your phone, unlock it, and open up, your favorite investing app, the one where you buy your stocks or check your retirement.
Yeah, everybody's got one now.
Right. Just look at the interface for a second. Like, really look at it. The colors, the layout, the little badges or streaks, if it has them. Now, ask yourself a really fundamental question. Does this feel like a utility, like a tool for managing your long-term financial future? Or does it feel maybe just a little bit like a video game?
I mean, it's a completely different aesthetic from the banking tools we had even, 10 years ago?
Oh, totally.
It's no longer just, rows of boring numbers on a spreadsheet. The typography, the haptic feedback when you press a button, the way notifications literally slide onto your screen. It is all meticulously designed to elicit a very specific physiological feeling.
Exactly. And that feeling, that digital architecture, is exactly what we are digging into today. Welcome to this deep dive. Today our mission is to unpack a really fascinating, highly detailed newsletter. It was published in July of 2026 by the Entrepreneur Law Group.
Yeah, it's a brilliant piece of analysis.
It really is. And we are going to explore this controversial but heavily documented thesis that they present. Basically, that the United States stock market has essentially split into two completely different realities. And the implications for your own money are pretty staggering.
Right, because this isn't just your standard debate about active versus passive investment strategies. The core argument the ELG newsletter makes is that one half of our market is currently operating on the exact same dopamine loops and reward mechanics that you would find on a Las Vegas casino floor.
Or built into a video game loot box.
Exactly.
Which is, that's a massive claim. We aren't just saying that trading carries risk. We all know that. We are saying that the underlying architecture of how retail investors interact with the market has fundamentally mutated. And the source text sets this up so brilliantly with what they call the two casinos in one building analogy.
Yeah, it's honestly the perfect framework for understanding this divide. If you imagine the entire U.S. stock market as this massive, towering skyscraper, the top floors represent what they call the patient market.
Okay.
This is where you find, your Vanguard 401ks, your target date retirement funds, the broad S&P index fund.
Right, the incredibly boring, set it and forget it stuff.
Precisely.
Yeah.
Deliberately boring. And here is the most crucial data point to understand about those top floors. The overwhelming majority of household equity wealth in America actually lives up there.
Just sitting there.
It just sits there quietly compounding in silence. The newsletter highlights a remarkable statistic. In 2024, only about 5% of non-advised Vanguard 401k participants executed a trade at all over the entire year.
Wait, really? Meaning 95% of those investors literally did nothing.
Literally nothing. They just let their paychecks auto-invest and went on with their lives.
Wow.
And if you drill down into pure target date fund investors, the people who just, pick the year they want to retire, that number drops to just 1% who actively traded.
That sounds incredibly healthy.
Oh, it is incredibly healthy. It is the textbook definition of patient capital. But the problem, rather the structural shift, happens when you take the elevator down from those quiet top floors to the ground floor.
Right. The velocity market.
Exactly. The ground floor is where all the flashing lights are. This is the realm of zero-day options, meme stock squeezes, highly leveraged single stock ETFs, and prediction event contracts.
It's like, I was thinking about this, it's like walking into a traditional quiet bank vault, right?
Yeah.
But to get to your safety deposit box, you have to walk through a neon-lit casino floor where someone is constantly handing you free drink tickets and screaming about a jackpot.
That's exactly what it feels like.
And the crazy part is, both of those environments, the vault and the casino, are completely legal. They both technically operate under the broad umbrella of, quote unquote, the financial market. But they are engineered for completely contradictory human behaviors. The top floors hold all the actual wealth, but the ground floor generates all the noise, the vast majority of the daily trade volume, and, most importantly for Wall Street, the majority of the broker profits.
And that profit motive is the skeleton key to this whole deep dive. Because the industry didn't just accidentally build a casino on the ground floor.
Right.
They didn't just stumble into gamification. The newsletter dives deep into the actual behavioral neuroscience used to build these trading apps. They built the ground floor using the exact same blueprints that behavioral psychologists use to condition habits.
So let's talk about those blueprints, because this is where the finance story becomes a human psychology story. If you look at the design of these velocity market apps, they are heavily rooted in the foundational work of B.F. Skinner. We're talking about operant conditioning.
Yeah.
The classic experiments with pigeons and rats in boxes.
Right. Skinner made this discovery in the mid-20th century that totally revolutionized behavioral science. He found that if you want to create the highest, most compulsive response rate in a subject, meaning you want that rat to keep pressing the lever and you want to make that behavior incredibly hard to break, you do not reward them every single time they press it.
Because if you reward them every time, they just press it when they are hungry, they get what they want, and they leave.
Exactly. It just becomes a predictable utility. Instead, Skinner discovered the variable ratio schedule. You reward the subject on an unpredictable, randomized basis. They press the lever 5 times and get nothing. Then the 6th time, they get a massive reward.
Okay.
Then they might get a reward on the next press, or it might take 20 more.
You never know which pool is going to pay off, which is the literal, exact underlying mechanic of a slot machine. And as the newsletter points out, it is the exact psychological mechanic of trading a same-day option position. You win big occasionally, you lose small amounts constantly, and the uncertainty of not knowing if the next tap on your screen is going to be a 500% gain is what keeps you tapping. The uncertainty isn't a flaw in the system, it is the core feature driving the dopamine response.
And we don't even have to guess about this anymore. Neuroscientists have actually mapped exactly how this plays out in the human brain. The authors of the newsletter cite a really pivotal 2009 study published in the journal Neuron.
Oh, right.
Yeah, it was by a researcher named Luke Clark and his colleagues.
Yes, I read through the section on Clark's study, and the concept of the near-miss effect absolutely blew my mind, because I think we all intuitively understand why winning feels good. But Clark's team looked at what happens when you almost win. I want you to break down exactly what's happening in the midbrain here, because this seems like the missing link between a casino game and a stock chart.
It is the missing link. In a game of chance, a near miss is a failure that looks remarkably like a success. Imagine you're at a slot machine. The first wheel stops on a cherry.
Okay.
The second wheel stops on a cherry. Your heart rate spikes. The third wheel is spinning, and it lands 1 tick past the cherry. You lost your money.
But how does the brain interpret that?
Well, Clark's team put subjects in an fMRI machine to watch their brain activity during these exact near misses. They found that when you experience that near miss, the dopaminergic midbrain circuitry, the reward center of your brain, lights up in almost the exact same way as if you had actually hit the jackpot.
No way.
Yes. Your brain practically floods itself with the reward chemical even though you lost your money.
Wait, so your brain is chemically rewarding you for losing as long as the loss felt like it was a split second away from being a massive win?
Exactly, because the brain interprets the near miss as a sign that you are acquiring skill. Even in a game of pure chance, it tells you, oh, you were so close, you've almost figured this out, do it again immediately. The near miss actively enhances the motivation to keep playing. In fact, follow-up research has shown that the severity of a person's gambling problem directly predicts how strongly their midbrain responds to those near misses.
Okay, so translate this from a slot machine to an investing app. Because there are no spinning cherries on Robinhood or Weibull, how does a near miss work when you're, trading derivatives?
Think about the mechanics of an options contract that expires at the 4 p.m. closing bell. Let's say you bought a call option, betting a tech stock would hit $150 a share. It's 3:55 p.m., and the stock is at $149 any cents.
Right.
You are watching that line chart violently tick up and down. $149.85, then $149.95. You are mere cents away from your contract, paying out thousands of dollars.
The adrenaline is pumping. You were just glued to the screen.
And then the bell rings, the stock closes at $149.98, and your option expires completely worthless. It goes to absolute zero.
Oh, wow. It's a near miss with a brokerage statement attached to it.
Precisely.
Mm-hmm.
You got the adrenaline spike, you got the dopamine hit of the anticipation, and when it barely misses, your brain doesn't process it as a total financial loss. Your brain tells you, your thesis was right, your timing was just off by a minute, you almost had it, fund your account and do it again tomorrow.
That is wild. And what's wilder is that this isn't just some abstract academic metaphor, right?
Yeah.
The ELG newsletter makes it abundantly clear that this intentional gamification is adjudicated fact. The regulators have already had to step in and police this.
Yeah, the regulatory footprint is undeniable. We aren't just speculating about how these apps are designed. Look at the enforcement record. In June of 2021, Robinhood was hit with a $70 million fine from FINRA, which at the time was the largest financial penalty FINRA had ever ordered.
And what was the bulk of that fine actually for?
A massive portion of it was over misleading communications and systemic failures in their options approval process. They were basically using automated algorithms to approve novice retail customers for complex, high-risk options trading, even when those customers clearly didn't meet the eligibility criteria or, understand the risks.
But the enforcement didn't stop with FEC NRA. The newsletter also highlights a much more recent case from January 2024, where Robinhood settled with the Commonwealth of Massachusetts for $7.5 million. And if you read the complaint from Massachusetts, it is explicitly, directly about gamification.
Yes, the Massachusetts Securities Division went straight after the interface. They alleged that Robinhood was actively violating state fiduciary duty rules by deploying manipulative design elements.
They specifically cited things like using digital scratch ticket mechanics to reveal free stock rewards. You literally had to rub your phone screen to see what you won. And of course, the infamous confetti animations that would burst across your screen whenever you executed a trade.
Right, along with curated most traded lists that induce herd behavior and constant aggressive push notifications. Now, to be fair, as part of the settlement, Robinhood did agree to stop using celebratory imagery tied to the frequency of trading, and they have always publicly rejected the premise that their app is a game.
Sure.
But the facts remain. The behavioral design of the app was the central subject of a multi-million-dollar enforcement action.
But I want to push back on this a little bit, or at least look at the underlying motive, because it takes a lot of highly paid software engineers and behavioral psychologists to build out variable ratio reward systems and near-miss feedback loops.
Oh, absolutely.
Why go through all the trouble of engineering digital confetti bursts? Like if I log into my Vanguard app, it's just a white screen with some black text. Why are the velocity brokers trying so hard to keep me tapping?
Because of the underlying economics of how they knit their money. It all comes down to a mechanism called payment for order flow, or PFOF.
Right, PFOF. And this is where a lot of people get confused. Because for a long time, the pitch was, we are democratizing finance. Trades are now commission-free. But free trades aren't actually free, are they?
Not at all. If you aren't paying a commission, you are the product. When you hit buy on a commission-free app, the broker doesn't send your order directly to the New York Stock Exchange. They route your order to a massive market maker, usually a high-frequency trading firm.
Okay.
That market maker executes your trade, and in exchange for the privilege of handling your order flow, they pay your broker a small rebate. That rebate is payment for order flow.
Okay, so let's translate that into actual numbers, because the SEC working paper data cited in the newsletter is staggering. They use basis points to measure this. And for you listening, a basis point is just 1/100th of 1%. So if I buy $1,000 worth of a regular boring stock, say I just buy a broad index ETF, how much does the broker make from routing that trade?
According to the SEC data, the broker gets a rebate of about 0.8 basis points for a regular equity trade. So on a $1,000 stock trade, the broker makes about 8 cents.
8 cents. Not exactly a windfall.
Yeah.
But what happens if I take that same $1,000 and instead of buying a stock, I buy an options contract?
If you trade an option, the rebate jumps to about 8 basis points. The broker makes roughly 80 cents on that same $1,000.
That is a 10-fold increase. They make 1,000% more revenue per dollar traded if they can convince me to trade an option instead of a stock.
Exactly. And that economic reality is the engine driving the entire ground floor casino.
So if you are the CEO of one of these brokerages and you know you make 10 times more money when your user trades an option, isn't every single push notification, every streak badge, every top daily mover list essentially a behavioral nudge? You are intentionally nudging the user away from the boring, low-margin equity product and pushing them to the highest margin, highest risk derivative product on your shelf.
You've hit the nail on the head. This is the fundamental conflict of interest at the heart of the velocity market. When a platform's revenue scales almost entirely with the frequency and type of your trades, rather than the long-term outcome of your investments, the entire user interface is going to be optimized to increase high-margin trade frequency.
Wow.
The system is structurally incentivized to graduate you from a patient saver into a high-volume options trader.
Which brings us to the absolute zenith of this phenomenon. If the goal is to get the user to trade high-margin options as frequently as humanly possible, the market had to invent a product that expires so fast you have no choice but to keep buying it.
The purest, fastest lottery ticket ever invented for the financial markets.
The zero-day option, 0 DTE, 0 days to expiration.
Yeah, and this is where the structural integrity of the entire market gets called into question.
So let's really break this down because 0 DTE has completely taken over Wall Street. What exactly is a 0-day option and how does it compress the timeline of investing?
A 0-day option is exactly what it sounds like. It is an options contract, usually tied to the S&P 500 index, that is born and expires on the exact same trading day.
Okay.
You buy it in the morning when the market opens, and by the time the bell rings at 4 p.m., it either pays out a profit or it goes to absolute zero.
It compresses the entire life cycle of an investment research, execution, holding period, and realization of gains or losses into 6.5 hours.
Exactly. Historically, if you bought a stock, you held it for years. If you bought a traditional option, it might expire in 3 months or 6 months. You had time for your investment thesis to play out. With a 0-day option, there is no thesis. It is a pure, unadulterated bet on intraday volatility.
And the growth of this specific instrument is just staggering. The ELG newsletter lays out the timeline, and it looked like a hockey stick chart. Back in 2016, same-day expiry contracts made up about 5% of the total S&P 500 options volume.
Right. Back then, it was just a tiny, esoteric niche product used mostly by institutional hedgers to manage very specific short-term risks.
But by the end of 2025, the newsletter shows that 0 DTE contracts accounted for a massive 59% of all SPX options volume for the full year. Over half. And there were specific months late in 2025 where it actually crossed 62%. We're talking about roughly 2.3 million of these contracts trading every single day just on the S&P 500.
It is an unbelievable shift in aggregate market behavior, and it's not just the S&P. Across all underlying stocks and indices, 0-day options made up over 24% of the total U.S. listed options volume in 2025.
Wow.
And bear in mind, 2025 was a year where total options volume hit a record 15.2 billion contracts.
Right.
And who was trading all of this? The data shows that retail traders, the everyday people tapping on their phones, account for roughly half of that 0-day order flow.
Okay, but here is the most important question for anyone listening who might be tempted to try this. What actually happens to the people buying these 0-day contracts? Because if you are betting on what the market is going to do between lunchtime and 4 p.m., that sounds incredibly dangerous.
Well, the ELG newsletter pulls some incredibly striking backtest data straight from SIBO.
That's the exchange, right?
Yeah, SIBO is the Chicago Board Options Exchange. They are the primary venue where these S&P options trade. SIBO ran a mathematical test to see what happens to a systemic buyer of these products.
They tested a 0 DTE SPX straddle, right? Explain what a straddle is really quickly for us.
A straddle is when you buy both a call option and a put option at the exact same strike price. Essentially, you aren't betting on whether the market will go up or down. You are betting that the market will move violently in one direction or the other. You need massive volatility to overcome the premium you paid for both contracts.
Okay, so you are just betting on pure chaos.
Yeah.
So SIBO runs a backtest. What happens if you routinely buy a 0 DTE straddle shortly after the market open at 9:30 a.m. And you blindly hold it until the end of the day to see if chaos strikes? What is the expected result of that trade?
The median payout of that trade is negative $3.28.
What, negative?
Yes, negative $3.28. It is a mathematically guaranteed loser over time. If you map out the distribution of outcomes, it produces a textbook lottery profile.
Okay, how so?
The vast, overwhelming majority of trades are small, steady, agonizing losers. Your option premium just decays to zero as the clock ticks away. But those steady losses are punctuated by a very tiny number of massive 1,000% winners on days where a surprise news event crashes or spikes the market.
It is exactly like a scratch-off ticket. I was reading this section and trying to come up with an analogy, and the newsletter nailed it. A 0 DTE option is fundamentally no different than a scratch-off ticket you buy at a gas station counter.
It maps perfectly.
Think about it. It costs very little upfront to buy one out-of-the-money contract. It resolves instantly, by dinner if you won or lost. And mathematically, it almost always loses. But occasionally it pays off 10 to 1. And it's sold by a broker who makes their money on the massive volume of tickets sold, completely indifferent to whether you actually win.
The structural similarities are undeniable.
But the crucial difference, and this is what makes the velocity market so much more potent than a gas station, is that the local gas station does not send a push notification to your phone at 9:30 a.m. telling you that today's scratch-offs are particularly exciting.
Right.
The gas station doesn't give you a digital leaderboard showing you which scratch-offs your friends are buying. The distribution network is living inside your pocket.
And we have to look at how the broader financial system has morphed to support this explosion of zero-day gambling. The plumbing of the market has mutated.
Right, because you can't have a casino without massive amounts of leverage.
Exactly. Look at the margin debt figures detailed in the source. FINRA reported that total margin debt, which is money retail and institutional investors borrow from their brokers to buy more securities, hit an all-time record of $1.18 trillion in October of 2025. That was a 45% increase year over year.
So people are borrowing over $1 trillion to fund this velocity.
At the exact same time, investor-free cash balances in those accounts hit a record low. People are tapping out their cash reserves and levering up to stay at the table.
And they aren't just borrowing money. They are buying products that are structurally levered from the inside out. The newsletter points to the massive boom in leveraged single-stock ETFs.
This is another massive pillar of the ground floor casino. These are exchange-traded funds that promise to double or triple the daily return of a single, highly volatile stock. Think of a 3x leveraged NVIDIA ETF or a 2x leveraged Tesla ETF.
And the timeline of their growth is crazy. These single-stock leveraged products didn't even exist in the U.S. until July 2022. The SEC finally allowed them, and by mid-2025, they had amassed over $17 billion in assets. But anyone who understands the math knows these are notoriously terrible products to hold for anything longer than a day trade, right? Because of volatility decay?
Yes, volatility decay is the silent killer in these products, and it's crucial to understand how the math works. These ETFs reset their leverage every single day.
Walk us through an example of how that destroys capital.
Let's say you have a regular unleveraged stock trading at $100. On Monday, the market gets spooked and the stock drops 10%. It's now worth $90. On Tuesday, the market recovers and the stock goes up 11.1%. You are exactly back to $100. You survived the chop.
Okay, straightforward. But what if I bought a 3x leveraged ETF on that same stock?
Let's run the same math. On Monday, the underlying stock drops 10%. Your 3x ETF drops 30%. Your $100 investment is now only worth $70.
Out.
Now it's Tuesday. The underlying stock goes up 11.1%. Your 3x ETF goes up exactly 3 times that amount, which is 33.3%. But here's the trap. You are earning 33.3% on your new balance of $70, not your original $100.
Okay, let me do the math. A third of 70 is about 23. So 70 plus 23, your ETF is now worth about $93.
Exactly. The underlying stock went from $100 to $90 and back to $100. It is perfectly flat. But your 3x leveraged ETF went from $100 to $93. You just lost 7% of your money to pure mathematical friction. That is volatility decay. It is an invisible tax on holding leverage in a choppy market.
And yet, knowing that mathematical reality, retail investors are pouring billions of dollars into them. Why? Because they aren't holding them as investments. They're using them as intraday betting slips. Industry insiders are openly quoted in the newsletter attributing these flows to a gambling culture, not an investing culture.
And to complete the casino analogy, we have to talk about the hours of operation. Because what is a casino's best psychological trick?
They remove all the clocks from the walls and they don't have any windows. You never know if it's 2:000 p.m. or 4:0 a.m. Time stops.
The financial markets are currently trying to do the exact same thing. The institutional push for 24-hour trading is very real. By 2025, we saw the launch of overnight index options and tokenized stock products that trade on weekends. The New York Stock Exchange extended hours activity reached roughly 11% of total daily volume.
They want to remove the closing bell. They want the market to be a continuous, unbroken feed of action.
Because if the casino never closes, the variable ratio schedule never has to pause.
Okay, so let's summarize the ground floor. We have trading apps operating on the neuroscience of a slot machine. They are selling derivative products like zero-day options that have the mathematical expectancy of a lottery ticket. The whole ecosystem is fueled by $1 trillion in margin debt and leveraged ETFs that structurally decay over time. And they are actively trying to make sure the casino never closes.
That is an accurate, data-driven description of the velocity market.
Which is terrifying. But if the trading app has become a casino, what happens when it literally, functionally merges with the sportsbook? Because that is the next major structural shift the ELG newsletter highlights, and it brings a whole new set of data into the picture.
This is where the sociological impact of all this becomes highly measurable. To understand this convergence, we have to step slightly outside of Wall Street and look at the massive sports betting boom that happened post-2018.
Right. 2018 was the year the Supreme Court struck down the federal prohibition on sports gambling in the Murphy v. NCAA case. They essentially handed the issue back to the states.
And the states moved incredibly fast. Since that 2018 ruling, 39 states plus the District of Columbia have legalized some form of sports betting. The friction was completely removed. You didn't have to go to Vegas or find an illegal bookie anymore. You just had to download DraftKings or FanDuel. And the volume of money that poured into this new legal market is staggering.
What are the numbers?
In 2024 alone, Americans legally wagered $149.9 billion on sports. That generated nearly $14 billion in pure revenue for the operators.
$150 billion wagered in a single year. That is a massive structural shift in consumer behavior. Yeah. But let me play devil's advocate for a second. If I want to throw $50 on the Kansas City Chiefs to win the Super Bowl on a Sunday, why does that matter to Wall Street? Isn't that just people spending their discretionary entertainment budget? Why does a sports betting stat belong to deep dive above the stock market?
That was the assumption for a long time, that gambling budgets and investing budgets were completely separate mental accounts. But the data proves that assumption is dead wrong. The newsletter cites a critically important working paper from the National Bureau of Economic Research, the NBER, which was revised in June 2025.
And what did the NBER researchers find?
They conducted an exhaustive study looking at a massive panel of household financial transactions. They wanted to see exactly what happened to a family's finances in the months and years immediately after sports betting was legalized in their specific state. They found a direct causal household harm crossover.
I'm guessing people didn't magically increase their 401k contributions when they downloaded the sportsbook.
No, quite the opposite. The researchers found that the legalization of sports betting led to a direct 14% drop in household brokerage account deposits.
Wow. A 14% drop in money being set aside for the future.
It gets even more specific and mathematically damning. They calculated that for every $1 a household spent on sports betting, it reduced their net investment by roughly $2. The money wasn't just being diverted from buying movie tickets or going out to dinner. It was actively, disproportionately cannibalizing their financial future.
That is heartbreaking.
And it gets worse for vulnerable demographics. For financially constrained households, meaning people who are living paycheck to paycheck and don't have a massive buffer of savings, the introduction of mobile sports betting caused a 24% spike in bank account overdrafts.
So the data is incredibly clear. Easy, frictionless access to high-frequency betting fundamentally damages the median household's ability to save and invest. It actively destroys wealth.
Yes. That NBER data gives us an established, proven control group. We know exactly what happens to retail finances when you put a betting machine in their pocket, which makes the next evolution in the brokerage industry deeply concerning.
The merging of the apps. Because if you open Robinhood right now in 2026, it is no longer just a place to buy stocks and options. They have introduced a completely new asset class.
If you look at Robinhood's Q1 2026 earnings data, the numbers tell a fascinating story. They reported strong overall net revenue, about $1.06 billion. But the line item that should catch every financial regulator's attention is their other transaction revenue. This segment is primarily driven by what they call event contracts.
Let's explain event contracts, because this is where the line between Wall Street and Las Vegas gets totally erased.
Functionally, an event contract is simply a binary bet on a real-world outcome. Will the Federal Reserve cut interest rates by 25 basis points next week? Will a specific political candidate win the Electoral College? Will the temperature in New York be over 80 degrees on Tuesday?
So you aren't buying a fractional share of a company. You aren't investing in cash flows or taking an equity stake in a productive asset. You are wagering on a yes or no proposition. It is a prediction market.
Exactly. It operates structurally identical to a sportsbook money line. And in Q1 of 2026, Robinhood's revenue from those event contracts grew by roughly 320% year over year. They saw a record 8.8 billion event contracts traded on their platform in a single quarter.
8.8 billion. So the fastest growing segment of a major U.S. retail brokerage isn't equities, it's essentially outcome betting. The prediction market, the sportsbook, and the traditional brokerage are collapsing into a single, unified interface.
And this brings us to the trillion-dollar question.
Right. If we know that aggregate retail day trading is mathematically a negative expectation activity, most people lose money trying to time the market. And we now have hard NBER data showing that sports betting actively cannibalizes household investments and drives massive spikes in overdrafts. What happens to the median American saver when they can bet on the Super Bowl, buy a fractional share of a Vanguard index fund, and trade a zero-day option all on the exact same screen using the exact same pool of capital?
You are systematically dismantling the mental accounting barriers that historically protected people. In the past, you had investment money that lived in a stuffy brokerage account, and you had entertainment money that you took to Vegas or spent at the track.
Right, there was friction between those two pots of money.
But when they sit side by side in the same app, flashing the same green and red notifications, using the exact same variable ratio reward schedules that hit your dopaminergic midbrain, the human brain simply struggles to differentiate between buying a 10-year treasury bond and betting on a coin flip.
It all just feels like action.
Exactly. The medium is the message, and a casino never rests. It just continuously books a new star act to keep the crowds coming in.
I love that framing from the newsletter. Because the underlying machinery of the ground floor, the skitter boxes, the zero-day options, the leverage, the event contracts, that machinery stays the exact same. It's perfectly optimized. But to keep the players engaged, the casino constantly has to change the narrative running through the machine.
The content has to evolve. If we look back, in 2021, the marquee outside the casino said, meme stocks. That was the era of GameStop, AMC, and Roaring Kitty. The crowd flooded in to play that narrative. In 2024, the marquee said, election markets.
And now, in 2026, the marquee flashing in neon light says artificial intelligence.
Which brings us to one of the most famous bears in the history of finance taking on this exact AI bubble.
Yes, let's talk about Michael Burry, the investor who famously called the 2008 subprime mortgage crisis the guy Christian Bale played in The Big Short. Over the July 4th weekend in 2026, Burry goes onto social media and basically declares that the end is nigh. In classic Michael Burry fashion, he quotes Jack Nicholson's Joker from the 1989 Batman movie, Dancing with the Devil in the Pale Moonlight.
It's very cinematic, very cryptic. But the core of his argument connects perfectly to the thesis of this deep dive. He explicitly called the current AI market narrative nothing more than mass addiction.
Mass addiction. So he is directly fusing the two concepts we've been talking about. He believes the AI assets themselves are wildly, structurally overpriced, but more importantly, he believes the retail crowd's relationship to those assets is compulsive, not analytical. They aren't investing in AI. They are addicted to the volatility of AI.
He's arguing that the entertainment market, the Velocity Casino, is currently hyper-focused on semiconductor chips and large language models. And Burry put his money where his mouth is. His 13F filings from late 2025 showed massive nominal put positions against the leaders of the AI boom.
Let's explain a put position quickly. A put option is essentially a bet that a stock's price will fall. It gives you the right to sell the stock at a specific price. So if the stock crashes, your put option explodes in value.
Exactly. And Burry's filings showed put options referencing roughly 1 million shares of NVIDIA and 5 million shares of Palantir,
to the tune of over $1 billion in notional value. Now, to be fair, notional value overstates the actual dollars he has at risk. The premium he actually paid for those options was smaller. But the directional bet is undeniably huge. He is comparing the current semiconductor index to the absolute zenith of the 1999 dot-com bubble.
And while Burry provides the cinematic flair, he is not the only one pointing out the structural weirdness of the AI trade. The ELG newsletter brings in a much more institutional voice to validate this concern, Torsten Slok, the chief economist at Apollo Global Management.
Right. Slok provides the suit-and-tie, data-driven version of Burry's warning. And Slok uses a phrase I found terrifying for anyone with a 401k. He warns of a diversification illusion in the current market. What does that mean?
When you buy a broad S&P 500 index fund on the patient top floors of our market skyscraper, you sleep well at night because you think you are broadly diversified across 500 of the largest companies in the American economy, right? If one industry struggles, another one carries the load.
Right, that's the whole point of passive indexing. You own a piece of everything.
But Slok points out that the concentration of returns at the very top of the index has reached levels we haven't seen since just before the dot-com crash. The top 10 names in the S&P 500 now make up over 40% of the entire index's market capitalization.
Let that sink in. You think you own 500 distinct companies, but 40% of your retirement account's performance is basically dictated by what 6 or 7 tech CEOs decide to do on a Tuesday.
It is an illusion of safety. And Slok highlights a massive, glaring divergence in the underlying business fundamentals to prove his point. If you look at the data between the first quarter of 2023 and the first quarter of 2026, the profit margins for the Magnificent Seven tech giants, your Apples, Microsofts, NVIDIAs, rose from roughly 15% to 25%.
They are printing money hand over fist.
They are. But look at the profit margins for the other 493 companies in the S&P 500 over that exact same 3-year period. They completely stalled out near 10%. They saw zero margin expansion.
So the entire U.S. stock market's record-breaking performance is balancing on a tiny, incredibly expensive sliver of AI-related companies, while the rest of the actual economy is just treading water.
Exactly. Slock's warning is that these tech giants are making historically massive capital expenditures into AI infrastructure building massive data centers, buying billions of dollars of GPUs. If those massive investments do not translate into broad, economy-wide productivity gains that lift up those other 493 companies, the math stops working, and we are facing a very violent, very painful repricing of the entire market.
And to really ground that risk, the newsletter cites a fantastic letter from Brasada Capital that looks back at the history of technological revolutions. Because it is so easy to say, but AI is real. It's going to change the world.
This is a crucial historical perspective to understand. Because the technology can be 100% real, it can fundamentally change the trajectory of human history, and it can still completely ruin the people who embodied in it early.
It's the difference between identifying a macro trend and identifying a durable corporate winner.
The Brasada letter traces the patterns of innovation. Look at the 1980s personal computing revolution. The early undisputed leader was IBM. Everyone bought IBM. But who was the eventual durable winner that captured the massive wealth? Microsoft and the Windows ecosystem.
Look at the early internet of the late 90s. The dominant force, the darling of Wall Street, was Yahoo.
And then a little startup called Google came along and completely ate their lunch. Look at smartphones in the 2000s. BlackBerry seemed completely unassailable. They owned the corporate market.
Until Steve Jobs stood on a stage in 2007 and introduced the iPhone, and BlackBerry was practically obsolete overnight.
You can trace this pattern all the way back to the 19th century railroads or the early automobile companies in the 1910s. The cycle is stunningly consistent. A world-changing technology emerges. Massive amounts of speculative capital flow into the early leaders, a bubble forms in the velocity market, the bubble pops, and the early financiers are frequently wiped out, even as the underlying technology goes on to become a boring utility that society relies on every day.
So the warning here is that the AI revolution might be completely real, but the current valuations of the hardware and infrastructure companies might still be a massive financial trap. It's a classic bubble dynamic. But having said all that, I want to take a moment to challenge Michael Burry's timing here, based on what the ELG newsletter points out.
Please do. Burry is a fascinating figure to analyze.
Look, Burry was early, and he was absolutely right in 2008. He nailed the subprime mortgage crisis, and he deserves immense credit for seeing the rot in the system. But he has been early and totally wrong on several major macro calls since then. He has predicted multiple crashes over the last decade that simply never materialized. And as the authors of the newsletter astutely point out, in the world of options trading, being early and being wrong look exactly the same until your contract expires.
That is the most brutal truth of derivatives. You can have a perfect macro thesis, but if your timing is off by 3 months, your option expires worthless and you lose 100% of your capital.
Exactly. If you short the market today based on sound fundamentals and a gamified retail crowd keeps pushing the stock up for 2 more years, you lose your shirt, even if the thesis eventually plays out in 2028. And beyond his timing, there's a deep irony here that the newsletter calls out, which I find genuinely hilarious. Michael Burry, the guy who was calling the market mass addiction, deregistered his investment firm in late 2025 and launched a paid Substack newsletter,
charging $379 a year for access to his thoughts.
It is deeply hypocritical. The biggest critic of market addiction is now monetizing his perpetual bearishness through a subscription engagement product. He has transitioned from managing actual capital to managing audience attention. He's feeding the exact same doom-scrolling loop he's criticizing.
It's a fair critique. He has become a content creator in the financial entertainment complex. But whether Burry is right or wrong about the impending AI crash, the sheer velocity of this trade fueled by zero-day options and event contracts is forcing the American legal system to confront a very old, very fundamental question.
Which brings us to the most complex and arguably the most important part of this entire deep dive, the legal boundary. What exactly is the legal difference between a financial trade and a casino bet?
Because right now, on the ground floor of our market skyscraper, those two concepts are smashing into each other at 100 miles an hour, and the law is struggling to keep up.
And this isn't a new philosophical debate. There is over a century of case law trying to define the line between investing and gambling. The newsletter breaks down what they call the classic test. Where does that test actually come from?
It goes all the way back to a landmark Supreme Court case from 1905, Board of Trade of Chicago v. Christie Grain. That case, and the subsequent state gaming laws that followed it, established a legal framework for defining a wager. Generally speaking, the classic test says that gambling occurs when money is staked on an outcome that is determined predominantly by chance rather than skill, and importantly, it involves an event where the bettor has no independent economic interest.
Okay, let's break that down. No independent economic interest, meaning if I bet on a horse race, I don't own the horse. I don't own the track. I have no vested stake in the underlying economics of the race. I am just putting money on a random outcome for the sheer thrill of the payout.
Exactly. It's a pure wager with no broader economic utility. It is a zero-sum game created out of thin air. Investing, on the other hand, legally involves staking capital on a productive asset, buying equity in a business, buying real estate, funding debt, with the expectation of a return based on actual cash flows and growth. It's positive sum. And in the middle, you have regulated speculation, like agricultural commodities and derivatives, which are technically zero-sum, but the courts ruled they serve a vital economic function, like hedging risk and providing price discovery for farmers.
But when you look at an event contract on a modern trading app, betting on whether a specific political candidate wins or whether a Marvel movie makes $100 million at the box office this weekend, that feels like it completely shatters the classic test. You have no economic interest in the movie theater. Where does that fit in the eyes of the law?
That is the exact live fight happening in the federal appellate courts right now. And it is incredibly messy. The ELG newsletter details a massive 2026 case in the Third Circuit Court of Appeals involving a company called Kalshi.
Kalshi is a platform that lists exactly these types of event contracts, right? I read the summary of this ruling, and it's wild. In April 2026, a divided panel of judges in the Third Circuit ruled that sports and event contracts listed on Kalshi, which is regulated by the CFTC, are legally considered swaps under the Federal Commodity Exchange Act.
Yes, they legally classified them as financial derivatives, not bets.
And the implication of that is massive, because if they are federally regulated swaps, the court ruled that federal law preempts state gambling laws, meaning a state like California or Texas cannot ban these apps by calling them illegal sports betting, because the federal court just declared them to be Wall Street finance.
Exactly. But the Kalshi ruling is not the final word, because the lower courts across the country are completely fractured on this issue. District courts in Tennessee and New Jersey agreed with the Kalshi logic. But district courts in Nevada and Maryland looked at the exact same types of event contracts and concluded the opposite. They ruled they are not swaps, they do not serve an economic purpose, they are just illegal gambling wearing a finance suit.
So you have a massive circuit split developing across the country. What's legal in one state is a felony in another, based entirely on whether a judge thinks it's a swap or a wager, which means this is almost certainly headed to the Supreme Court.
It has to go to the Supreme Court. The commercial magnitude is simply too large. You have billions of dollars in volume flowing through these platforms, and half the country's judiciary thinks it's federally protected finance, while the other half thinks it's state-level illegal gambling.
And in the midst of all this chaos, where are the regulators?
Yep.
Where is the Securities and Exchange Commission? If retail trading apps are blatantly using casino tactics and behavioral neuroscience to hook users, shouldn't the SEC step in and regulate the interface?
They tried to step in and then they blinked.
Explain what happened, because the newsletter points to a very specific failed rule.
In July 2023, under Chairman Gary Gensler, the SEC proposed a major rule aimed directly at the gamification of finance. It was called the Conflicts of Interest Associated with the Use of Predictive Data Analytics. It was meticulously designed to regulate the exact digital engagement practices we've been talking about, the behavioral nudges, the variable ratio rewards, the near-miss mechanics.
It was designed to outlaw the Skinner box. And what happened?
In June 2025, the SEC formally withdrew the proposal. They dropped it completely, formally stating they do not intend to issue final rules on the matter.
Why? Did Wall Street just sue them into submission?
The newsletter notes that this was one of 14 Gensler-era proposals that were quietly dropped. It was likely due to a combination of massive industry pushback, intense lobbying, and the looming threat of litigation under a current judicial climate that has been highly skeptical of broad administrative agency power. The SEC likely realized they would lose in court if they tried to dictate how an app's user interface is designed.
So the result is that there is currently no comprehensive federal rule governing gamification and brokerage apps. We are just left with this chaotic patchwork of state laws and broad, vaguely enforced ephemerized suitability rules.
And as the newsletter points out so clearly, a regulatory patchwork is exactly the environment where product design can endlessly outrun the law.
It always does. And the most fascinating part of this deep dive is realizing that none of this is actually new. If we look back at history, this exact dynamic is a recurring theme in American finance. We have been here before, just with different technology.
The historical parallel the newsletter draws is absolutely perfect. To really understand what is happening today with zero-day options, you have to go back to the 1880s and look at the bucket shops.
I had never heard of bucket shops before reading this source, but the story blew my mind. Set the scene for us. What was happening in the 1880s?
Imagine it's 1885. You are a telegraph operator, a clerk, or a factory worker in New York or Chicago. You want to speculate on the booming industrial economy, but you can't afford a seat on the New York Stock Exchange. The minimum lot sizes buying 100 shares of a railroad stock are way too expensive for the working class.
So Wall Street is completely closed off to you.
Exactly. So opportunistic operators opened up storefronts called bucket shops. You could walk in off the street and it looked just like a real brokerage. They had a chalkboard with prices and a telegraph ticker tape machine clicking away with live quotes from the actual exchanges.
But, and this is the genius part, when you placed a trade in a bucket shop, no actual stocks were changing hands.
Yeah.
You weren't buying equity in a railroad.
No, you were basically just making a side bet with the house on whether Western Union's stock was going to tick up or down over the next hour. You put down a tiny margin deposit, say $1, and if the stock moved against you by a single point, your margin was wiped out and your bet was closed.
The bucket shop wasn't routing your order to a lit exchange to provide capital to businesses. They were just taking the other side of your wager. If you won, the house paid you. If you lost, the house kept your dollar. And because the house always wins eventually, these places minted absolute fortunes off the working class.
And here is the craziest statistic. The volume of these side bets was staggering. By 1889, it was reported that these illegal bucket shops were handling wagers equivalent to about 1 million shares a day.
While the actual legitimate New York Stock Exchange was only trading about 140,000 shares a day, the derivative betting market was 7 times larger than the actual underlying market. The tail was completely wagging the dog.
It is the exact same dynamic we see today, with zero-day options dominating the S&P 500 volume. Eventually, the states cracked down and banned the bucket shops. That 1905 Christie Grain Supreme Court case we discussed earlier, that was part of the coordinated legal effort to crush the bucket shops by defining their activities as illegal gambling rather than commerce.
But the desire for high-velocity speculation never dies. Every generation just invents its own technologically updated version. In the 1880s, it was bucket shops and ticker tape. In the 1920s, it was massive margin speculation and illicit stock pools. In 1999, it was the day trading firms and .com chat rooms. And today, in 2026, it is zero-day options and event contracts humming on a supercomputer in your pocket.
The technology evolves, but the human neuroscience remains exactly the same.
So bringing this back to the legal fight today, if the Supreme Court ultimately decides that an event contract on a football game or a political election is a federally regulated financial swap protected by the CFTC, what is to stop these apps from rolling out contracts on literally everything? Could they roll out a financial contract on celebrity divorces? Could they let you bet on whether your neighbor defaults on their mortgage? Where does the definition of finance actually end?
That is the slippery slope that regulators and systemic risk analysts are terrified of. If everything can be classified as a swap, then the entire world becomes a casino floor managed by Wall Street. And the boundaries of the Commodity Exchange Act will be stretched so far beyond recognition that the term investing loses all meaning.
So what does this all mean for the person listening right now? We need to pull all these threads together. We've covered neuroscience, derivatives, legal battles, and history. How do we synthesize this?
The authors of the ELG newsletter synthesize this core tension brilliantly. To navigate the modern market, you have to be able to hold two seemingly contradictory truths in your head at the exact same time.
Which are?
Truth number one, buy wealth. The market is still a highly functional, patient vehicle for compounding savings. The vast majority of real dollars are sitting quietly in index funds on those top floors, funding businesses and growing over decades. The median long-term investor is not a gambler.
But truth number two.
By volume, by growth rates, by product design, and by broker economics, America has built a hyper-optimized casino right on top of its capital markets. The entertainment layer, the velocity market, is no longer a fringe element. It is the primary growth engine of retail finance.
It's the ground floor generating all the noise, the systemic risk, and the profit. And recognizing which floor you are standing on when you open your app is the most important financial skill you can develop in this decade. This leaves me with a thought that I cannot quite shake. Building on a really profound question the newsletter asked about teenagers growing up with video game loot boxes. If an entire generation of Americans is currently being conditioned to view finance as a fast-twitch, 15-minute dopamine loop, what happens to the global economy in 20 years? When those teenagers become the primary managers of capital, will the very concept of patient capital, the slow, boring, multi-decade funding that is required to build bridges, cure diseases, and fund retirements, simply cease to exist? Will long-term investment die out simply because it cannot compete with the neurological thrill of the digital casino?
It is a profound existential question about the future of capital allocation, and it's one we are going to have to answer very soon.
Led by Jack Russo, Computer Law Group LLP is a bespoke business litigation and founder-friendly boutique law firm with offices and licensed attorneys in Silicon Valley, New York, and Tampa Bay. And you can reach Jack at jack@computerlaw.com and his team at www.computerlaw.com, where the newsletter we referred to is published in detail and readily available, commitment-free with no paywalls or other charges.
Tune in next time on The Valley Current.